Good morning, everyone. And thank you so much for joining today's session. So as you can see on the screen, today's session is actually a two-part series. So today we are looking at part one on working internationally and whether there are any tax pitfalls that you would want to consider when you have people working internationally. So before I introduce today's agenda, I would like to introduce myself first and also introduce our other speaker. So everyone, my name is Catherine. I'm a senior tax manager in our corporate tax department here at Grant Thornton, Singapore. So I've had in my 9 years, I've had experience in working in both Australia and Singapore, dealing in corporate tax, and hopefully with my experience in two different tax jurisdictions, hopefully I'm very well placed today to discuss these issues that we'll go through. And with me, I also have Eng Min Law, who is a tax partner at Grant Thornton, Singapore. So Eng Min has over 30 years experience advising clients on the corporate tax matters in Singapore with a particular focus on international tax. So Eng Min actually leads our corporate tax practice here at Grant Thornton, Singapore. So just a couple of housekeeping before I kick off into our content. So our recording will be made available to you after today's session. We also have a Q&A at the end of the session today. As you may see, and as you're probably well equipped now with Zoom, there's a Q&A function. So please feel free to pop in your questions in the Q&A throughout the presentation or at the end, and we'll try and get through as many of your questions as we can at the end. So without further ado, let me share today's agenda topics and go through what we want to cover today. So as I mentioned, today is part one of a two-part series. So part one is really focusing on corporate tax, especially around permanent establishment, where this concept of working internationally comes in. What we'll go through is maybe we'll be going through a very brief background on a brief introduction on PE and why we consider this important in today's climate. We'll also introduce a few case studies for everyone to hopefully help conceptualize this idea of PE and working internationally. And then we'll round off the session with discussing potential ways in which you could mitigate the PE risk, or if you do have a PE, then what do you do next? And then, as I mentioned, we'll have the Q&A at the end of the session. We also have a part two, which will be in a different webinar session on the 17th of August. And part two really focuses on the people aspect of this idea of working internationally. So things, for example, around employer obligations for employee taxes and things like that. And so these are some of the items that we'll cover in part two. So let's kick off today with the actual content. So what actually is a PE and why would we consider it important in today's climate? So permanent establishment, or PE, is, when we talk about PE, is generally situations where you have businesses who have activities that are being done in another country. So the idea of a PE, generally speaking, is around where you have businesses operating in more than one country. And so there is that distinction between doing business with a country and doing business in that country. The latter, which may suggest more of a PE exposure or a taxable presence in that country. So I've taken this particular definition out of our Singapore Income Tax Act. And the definition talks about a fixed place where a business will be wholly or partly carried on. So there must be some element of fixed when we talk about PE. Now, it is also very important when we talk about PE that we also look at any double taxation agreements. So we can't just talk about the local tax jurisdiction's definition, but if there is a double taxation agreement or DTA, then we have to also look at that DTA, look at the articles within that DTA to see whether or not you may have a permanent establishment in another jurisdiction. And in most cases, in most jurisdictions, and it does happen in Singapore at least, is that the DTA does override the domestic tax legislation. So again, it is very important that we are looking at the DTA when we talk about permanent establishment. So there are various forms of PE. And so there's things like, for example, and these are things that we've taken from the DTAs themselves, where we have maybe a fixed placed PE. So the idea of that there being a fixed area from either geographical, temporal, or both situation. There's also things like construction PE, so where you have construction work being done for a significant period of time in another jurisdiction, that can also create PE. You can also have situations where you have people running around for you in another country, doing business for you or on behalf of you, and that can, in some circumstances, create PE as well. Maybe either as a service, what we could maybe colloquially say as a service or agency PE. There are also certain DTAs which talk about substantial equipment. If you have substantial equipment being operated or being used in another jurisdiction, again, that could also lead to a PE. Now, for today's session, we're only going to be really focusing on whether or not your employee or your people that you may have in another country could cause a PE. Because if we were to go through every single aspect of PE that some of the DTA articles have, we could be here for a whole day just to talk about the different areas of PE. So what we want to do today is really just focus on people and employees going to another country. And so why have we chosen this focus? And I think everyone here in today's session is probably aware of these things, but there has been a growing increase in staff mobility. Virtual assignments have been on the rise. This idea of work from anywhere is now a possibility, especially in this COVID-19 environment. And we looked at also a recent survey that was conducted by Grable and Wakefield that said that 46% of the respondents to that survey would actually consider relocating internationally. So there is a whole range of reasons why this sort of aspect of it is quite important, especially for today's climate. And so before I kick off into the case studies that we want to talk about today, we wanted to ask everyone a poll question on whether or not your company already have policies in place to assess the permanent establishment risk associated with employees that are not working in the home country of the company. So I give everyone a minute to go through this, but we have A, which means that maybe you have very well-defined processes and procedures. There are you have very clear set of guidance as to what to do and how to assess that risk. Or you might have B, which is you have something in place. It's quite a loose framework. It's based on experience. It's based on high-level views, but it might not be very well defined. Or maybe that it's at this stage you don't have anything, and in which case today's session is a great place to start. I'll give everyone a minute to go through that. Perfect, and now let's look at the results. So I see that most of you probably have something very loose about whether or not assessing a PE risk, which is great for you, because then maybe hopefully today's session can help you develop that even further. And also for those that have nothing in place. Now, for those that maybe have very well-defined processes and procedures in place, maybe is a question of whether or not have you recently reviewed it? Are they still applicable? Are they still relevant? Do you need to have a look at that again? And maybe throughout today's session, you might have a aha moment where you think, oh, I need to actually build that into our processes and procedures. So thank you so much for everyone for contributing to the poll. And so let's move on to our case studies. So as I mentioned, we're going to go through some case studies. We have identified 3 case studies to go through today. And these case studies have been, we've come up with these based on our experience and based on scenarios that we've had previously. And so with case study 1, we have a situation of a Singapore key employee working outside Singapore. So let me just give you the facts of the case first, which talks about whether or not this scenario could create a PE. So we have Ms. A, who's part of the executive management team of the Singapore company. So she is a PR of Singapore. Now, for personal reasons, she's had to travel to Thailand. She is intending to return to Singapore, and she will be in Thailand for less than 6 months. But because she's part of the executive management team of the Singapore company, while in Thailand, she'll be able to electronically sign contracts. The negotiation of those contracts will be done in Singapore, however. So I guess as a way to wake everyone up a little bit and to test everyone's knowledge, let's start off with asking, based on the facts you see now and based on maybe your own views, do you think that Ms. A would create a PE for the Singapore company in Thailand? And so we have, a definitive yes, a definitive no. Maybe you don't have enough information to decide right now, or you just don't know at this stage. And so I'll give everyone a couple more seconds to put in the results. Excellent. So most of you have said there's not enough information to decide, and I think that's probably accurate as well. Some of you have correctly said no. So it'll be interesting to see the way that you've responded is if it is in line in the way that we'll analyze it right now. So thank you so much for the poll results. And so the first key consideration will be, is there a DTA between Thailand and Singapore? Because as I mentioned at the beginning, if you have a double taxation agreement in place, you need to refer to that and the articles within the DTA to determine the permanent establishment, whether or not you've created a permanent establishment. So in this case, we do. So Thailand and Singapore does have a DTA. So looking at the specifics of the DTA then, there are obviously various forms of PE, and where do we actually start in seeing whether or not that creates a PE for Ms. A in Thailand? So we know that Ms. A is not there in Thailand for any particular project. So things like the construction PE, which requires a specific construction work or consultancy services being provided for a period of time, we don't need to look at those provisions, so we can put that aside. One of the common PEs that we have is also the fixed place PE. So where you have a fixed place of business through which the business is being wholly or carried on, then you actually might create a PE. And so when you look at the DTA, there are certain examples that they provide, not certain examples, but certain inclusions, I should say, of what can create a fixed place PE, things like a branch, an office, a factory, or one of the things is a place of management. So we need to also consider with Ms. A, can she actually be seen as managing business from Thailand? And so we need to think about, does she actually create enough of a fixed place in Thailand? I have given the facts of that she'll be probably there in Thailand for less than 6 months. Now, the 6-month rule is sort of a very commonly used, and it's in the OECD guidance as well, around considering whether something that is there for at least 6 months can maybe create a PE. The 6-month rule is not the end all that be all for PE. You need to look at other factors as well. But given that she's been there for less than 6 months, or she will be in Thailand for less than 6 months, maybe there is an argument to say that she hasn't created enough of a fixed element to consider it as a fixed place PE. But there is a particular clause in the DTA which talks about whether or not someone, and not someone that is a independent agent, but who has and habitually exercises the authority to conclude contracts. And so where that is, where you have that scenario, then that can create a PE. Even if she does spend less than 6 months, or even that she is not spending that much time in another jurisdiction, the fact that she has the authority to conclude contracts may actually lead to a PE exposure for the Singapore company in Thailand. The negotiation of the contract, as I mentioned before, there is an argument to say, well, the negotiation of the contract is pretty much being all done in Singapore. All she's doing is actually signing it. Now, if she did not have the authority and maybe the ultimate decision is not being made in Thailand, there could be an argument to say maybe that hasn't created PE, but you need to review what her roles and responsibilities are in determining the PE exposure in Thailand for Ms. A. Given that Ms. A has the authority to conclude contracts and any ultimate decision is being made in Thailand on contracts, I'm afraid to say that there's probably a high risk that there is a PE exposure in Thailand for Ms. A. The other aspect of it that we want to talk about is whether or not the Thai, in this case, tax authorities, maybe have administrative concessions because of COVID-19 travel restrictions. A lot of governments have actually put in administrative concessions for PE. Singapore is one of those jurisdictions, and we'll go through that administrative concession a little later on in Singapore. Now, given this is a Singapore-based webinar, I'm not going to go through the Thai tax rules and regulations, but it is something you may want to consider looking into if you have people stuck overseas because of travel restrictions, because of COVID-19. And so hopefully that analysis is something that you thought about, or if you haven't thought about it, maybe that's something that you can start thinking about if you have a scenario similar to case study 1. So I'll now move on to case study 2, which talks about, it's very similar in case study, very similar to case study 1, but with a very key difference in which this is a Singapore non-key employee who's working outside Singapore. So let me bring up the facts of this case then. So the facts are that we have now Mr. P, who is an engineer in the R&D team of a Singapore tech company. So he has an employment pass to work in Singapore. So he is not a Singapore citizen. He is not a Singapore PR. Mr. P is not part of any of the key management team of the Singapore tech company. Now, for personal or family reasons, he's had to fly back to the UK, and he flew back last year. However, because of the growing COVID-19 situation, unfortunately, Mr. P has been unable to obtain a permit from the MOM to return to Singapore. So at this stage, since he traveled back in 2020, he's been in the UK for more than 6 months in both, and I should say, apologies for that, but I should say 2020 and also 2021. Mr. P has continued to be employed by the Singapore company. So the Singapore company has valued his services and the role that he has. So he is still working for the Singapore tech company, still employed by the Singapore tech company while being in the UK. And he's performing engineering services, things like maybe some of the design work, some of the testing work within his R&D team for the Singapore tech company. So again, we want to put up a question to see for everyone to have a think about whether or not you think that Mr. P has created a PE for the Singapore company in the UK. So we have obviously yes. Based on the facts that you have, you absolutely think that he's created a PE, or maybe you don't think so. Maybe the things that he's done is not enough to create a PE. The other aspect is, of course, you don't have enough information at this stage to decide whether or not it's categorically yes or no, or you simply don't know at this stage as well. So I'll give everyone a few seconds to go through their responses. And apologies, just yes. So when I talk about PE, I'm talking about permanent establishment. Okay, so you can see the results here. A lot of you are mixed in terms of whether or not it is a yes or no. I think quite evenly sort of split between yes and no. Some of you think there's not enough information. Some of you don't know at this stage. Well, hopefully, as I go through this analysis, again, maybe these are some of the things that you thought about when you were answering the question. So again, we're going to look at the DTA between UK and Singapore because there is one that exists. So looking at the articles within the double taxation agreement between the UK and Singapore, there are certain things that we can look at. Again, there's no particular project, so things like construction work, we can put that aside. Now, for this particular example, with Mr. P, he has no authority to conclude contracts while in the UK. So he's not part of the key management team. He is just an engineering employee that's just doing services in the UK. So unlike case study one, the idea that because he doesn't have the authority to conclude contracts, that particular clause in the double taxation agreements would not apply in this scenario. Then we can look at whether or not Mr. P has created a fixed place, permanent establishment in the UK for the Singapore company. So again, when we're looking at fixed place, it talks about whether or not you have a fixed place of business through which the business of an enterprise is wholly or partly carried on. And that is wording that I've taken from the double taxation agreement. Now, for Mr. P, where he works is quite important. So there is no, in this example that we've given you for this case study, the Singapore company doesn't have an office in the UK. So for Mr. P to do his engineering services, to doing his employment duties, he actually is been working from home from the UK. So he has a home office. So like most people, and I'm pretty sure all of our participants today, everyone's working from home. So everyone's working from the home office. Mr. P is the same. So he's in the UK working from a home office. And so then the question is whether or not that home office can be considered as a fixed place through which a permanent establishment could arise. There is actually OECD guidance and commentary about home offices. So they look at the fact that if you have a home office that is being used on a continuous basis to carry on your business activities. And it is very clear, and it is clear that your company or your employer has required that employee or individual to use that home office to carry on the business, then potentially a home office can actually be a fixed place enough to actually expose the company to permanent establishment risk. If your home office is being used on an intermittent or incidental purpose, then that might not create a PE or permanent establishment exposure. But in this scenario, we have Mr. P, who has been in the UK for more than 6 months for both 2020 and 2021. So there is a significant period of time that he's been fixed in one location or in one jurisdiction. The home office is what he's been using on a continuous basis to provide or to actually carry out his employment duties. So unfortunately, in this scenario, and because the Singapore tech company is requiring him to use the home office to actually carry out his duties, unfortunately, the facts is leading to the fact that Mr. P could actually create a PE or permanent establishment for the Singapore tech company in the UK. There's also a question here that I've put in my second bullet point, which talks about, does the nature of the work that they are performing actually matter? And I've put that in because there are, in double taxation agreements, there are particular exclusions that can apply. And one of these exclusions is around preparatory or auxiliary activities. So even if you may have a permanent establishment because you might have a fixed place, if that fixed place is only being carried it's only being used to provide preparatory auxiliary activities, then you may be excluded from having a permanent establishment in the other jurisdiction. So having a look at the roles and responsibilities of that individual, what they actually do actually does have an impact on assessing permanent establishment risk. Now, for our scenario, for this case study too, we have Mr. P, who's providing engineering services within his R&D team of a Singapore tech company. So unfortunately, that is such a core part of the business that it would be very hard to argue that is preparatory or auxiliary activities in this particular scenario. Obviously, we will need to, if you have a very similar case, we'll have to look at it case by case. But in this scenario, unfortunately, Mr. P probably or would likely create a permanent establishment for the Singapore tech company in the UK. Again, I've put in another a comment around whether or not there's administrative concessions. For Mr. P, he was always intending to come back to Singapore. He was not intending to be in the UK for as long as he has. And it's only because he's unable to come back, that because of the travel restrictions, because of COVID-19, that he's been there in the UK for that long. So it is worthwhile to have a look at whether or not the UK tax authorities might have administrative concessions. Again, because this is a Singapore-based webinar, I'm not going to cover that. But we do have our Grant Thornton member firms out there who can help assist with that analysis. If you do have a scenario where you might have someone being stuck overseas and can't come back to Singapore because of the restrictions. So that's the end of case study 2. I will now pass on to Eng Min, who will actually take us through case study 3. So case study 3 is a little bit different. We have in this scenario a foreign company with an employee who is working in Singapore. So I will let Eng Min come on the screen now and take us through case study 3.
Right, thanks, Kat. Let me just run through the facts of case study 3 now. Okay, right. In case study 3, we have a case of an individual, Miss M, Singapore citizen, currently in Singapore, hired by an Australian company. intended for her to be relocated to Australia, but because of border closure and also subsequently she has some personal reasons, she has chosen, she said that she will remain in Singapore for the next 1 to 2 years. And she is somebody, she's a price hire, and OSCO is not prepared to let her go. So OSCO is going to keep her, and OSCO is going to allow her to work from Singapore during this period. Now, I have a poll question here before we look at the analysis. Okay, I'll give you a few seconds to complete this one. Okay, can we close the poll now? Can I see the results? Okay. All right, I think we have got like more than 50% saying, 65% saying is a yes. I guess that 65% probably is influenced by the period, because in the facts, we said that she'll be here for 1 to 2 years. And then the other 11% don't know. Maybe you know something about the DTA, depending on what she's doing in Singapore. Potentially, maybe there's no PE here. And then, yeah, you probably have to drill down further to find out what she's doing here to decide. So potentially none of them, all your answers may be right too. Okay, let us go through the analysis now. Okay, now I think the first thing first, when we looked at, a PE analysis, is to check whether there's a DTA between Singapore or between the two countries. So in this case, we're actually looking at between Singapore and Australia. So we'll have to see whether the DTA is of any use to OSCO, whether DTA would actually help OSCO avoid having a PE in Singapore. Like the earlier scenarios that you've seen, the earlier case study that you've seen, we're not talking about construction site, installation or assembly project, because we are focusing on Miss M and her presence in Singapore here. So we're actually focusing on people having employees working overseas. So in this case study, we have an Australian company having employees working in Singapore. Right. So, I mean, we will go through the usual analysis, which part of which Kat has actually gone through. Is there like a fixed place of business in Singapore? Where is she working from? What is she doing in Singapore? What sort of roles is she performing in Singapore? Is she running the Australian company from Singapore? If she's running the Australian company from Singapore, clearly the place of management of the Australian company will be here, and therefore there would be a PE here in Singapore. So, and then we also ask whether she can conclude contract. Now, in this case, if she can conclude contract, the treaty actually carve out the portion pertaining to the purchasing function. If she is only merely performing a purchasing function, i.e. she's just buying, she's just purchasing of goods for the Australian company, there is a carve out, and then the OSCO would not be considered to be having a PE here. But really, it depends on what she's doing here. But if she's fulfilling orders, securing orders, then yes, there's likely to be a PE here. And also, I think we talk about, whether, she can conclude contract, let's say customer contract, whether the negotiations are all done here, whether the signing of the contracts are done here. So, and because of the duration, her duration in Singapore, the very likelihood is that, there would be a PE here, but yes, we have to drill down into the facts, into the circumstances to basically check that. Now, in the earliest 2 slides on the case study, Kat has asked that you may have to check with the various countries to see whether there are any admin concession. Now, here in Singapore, IRAS has issued some. Let me just go through and explain what they are. And at the end of it, you will be able to conclude that perhaps it will not apply to this case, but it may be applicable to other situations. Okay. Right. Now, IRAS has issued an administrative concession on this. If you are a foreign company, you have employees working in Singapore in FY 2021, sorry, I think there's a mistake, FY 2020 and 2021, due to the COVID-19 travel restrictions, then IRAS will consider that you have no PE if you meet all these conditions that I'm going to go through. So number one is you don't have a PE in Singapore previously. So prior to FY 2020, you don't have a PE in Singapore, but maybe someone traveled to Singapore, an employee traveled to Singapore, and he or she is stuck here. So, okay, we look at some other conditions as well. And he or she is stuck here and there's no change in the economic circumstances of the company. You continue to do business in the same way. No change in your business model. So whatever you're doing, you continue to do. And this employee, whether he's here in Singapore or whether he's outside of Singapore, he's doing the same stuff. He's doing the same thing. He's performing the same role. And this extension, this concession has been applied to employees' presence in Singapore up to 31st December 2021. We don't know whether these dates will move or not. It has moved a few times, depending on how the COVID situation pan out. So at the moment, it's 31st December 2021. And for all intent and purposes, this employee's presence here in Singapore is really temporary, not intended to be on a permanent basis. And then IRAS also requires the employee to leave Singapore as soon as possible. As soon as when you can travel, the employee would have to leave Singapore, right? So what a foreign company would require to do in this instance would be to make sure that they have enough documentations to substantiate all these conditions that IRAS would require them to meet in order for them to avail themselves to this admin concession that there's no PE, even if they have like an employee, running the business from Singapore during this period, right? So that's the admin concession. Right. Now, if there's a PE risk, a permanent establishment risk, so what does that mean? Can you, okay, what does that mean? We can look at it later, but can it be mitigated, right? Okay, in the course of my work, we have actually provided quite a number of advice to our clients on the do's and the don'ts, what you can do. Now, if you need to send an employee outside of Singapore to another countries, or, what are the things that you have to make sure that that particular employees can or cannot do to make sure that either your PE risk is mitigated, or if there's a PE created, the amount of profits that's attributable to this PE is minimal. So depending on what are your objectives, you could basically, and the role of this person, you could actually set up some do's and don'ts. As you know, we already said that in most of the treaties, if you have someone who have the authority to sign the contracts on your behalf in a foreign country, the foreign country will want to say that, hey, you're running a business from here. If you're running a business from here, if you're trading operations, I would want to tax you on the profit. So what you will have to do is to make sure that if you do send someone outside of to a country outside of Singapore, then maybe you should restrict the ability of the person to enter into contracts. Okay, but that's not good enough, not signing the contract. You may also have to restrict the person's ability to negotiate contracts, because if everything is all done and then you send it across, to no man's land or to another country to sign, but it doesn't help in your argument that there is no PE, because substantially most of the terms have already been agreed in one place. And then the other one that you could really ensure is to make sure that the types of activities that will be performed by this person would be one of a preparatory or auxiliary character. Kat has explained a little bit just now. I'll just continue. So the key here is for it to be preparatory or auxiliary, it mustn't be part of the core business. So preparatory means maybe you're just carrying out some preparation work. You're testing the water. You're doing some market research to see whether you want to set up shop over in a certain country. So that will be considered preparatory. So you're just testing, you're just doing market research to see whether it's a suitable place for you to basically set up your business. Or if it's auxiliary, means you are supporting your own business and you're not like providing services to third party. So that would be considered auxiliary sort of activities. Now, when it comes to, you know, monitoring the time spent of the staff in the various countries, you are the company, and if you send your staff overseas, we don't just count them staff, you know, you don't just look at one staff and then that's it, you know, and then you say that, okay, this guy only spent like 30 days in country A, so it's okay. I know, no PE is trigger. For a company, you are one legal person. So what you have to do is you have to count or monitor the time span of all the staff, not just one staff, not staff by staff, but you are supposed to accumulate them. So very often, I think sometimes a lot of companies have the policy to say to each staff and say that you cannot go to this country for more than, you know, typically the magic number of 180 half a year, 182 or 183 days. But it doesn't work like that for a company. You have to basically look at the cumulative number of days spent by your staff in that country to see whether you trigger any PE. And then, I mean, the other point that I have is that if for whatever reason you have to you have to transfer that staff has to work in Singapore. Let's say you're a UK company. Now, if for whatever reason you have to send the staff to Singapore to work, then it is better for you to enter into a formal secondment arrangement to transfer the staff from the UK company to the Singapore company. And Singapore company will be the employer on the record to hire this individual. At the same time, depending on what this individual is doing, the Singapore company can charge the UK company a fee for the services that's been provided by this individual to, you know, to sort out this payroll costs and all. Right. So with this formal secondment, at least you cut away the umbilical cord between the UK company and the individual, because by the time he's in Singapore, he is employed by the Singapore company. Okay. Now, if you have a PE, what's next? Apology, I have a bit of a control. Okay. So if you have a PE, so what's next? So, okay, what you need to do is, if you have a PE, you have to check whether there's a tax registration requirement in that country. Now, different country has got different requirement. Singapore, there is no tax registration requirement, but there is a requirement for you to notify the Singapore revenue that you have income chargeable to tax if you have a PE in Singapore. But there is no so-called tax registration requirement. In some other countries, I do know that the moment you're there, there will be some tax registration requirement. And then you also need to check whether there's any tax filing requirement required in that country for your PE. And if there is a tax filing requirement, you then have to check, you know, whether what are the due dates, what are the things that you need to do in your filing. And also when you prepare your PE financial statement, whether it has to be audited, you know, those are the non-tax considerations, whether, you know, you need to submit a set of audited financial statement or whether you don't have to. And in ascertaining the filings that's required for the PE, you also need to check, you know, what sort of profit that you're going to drop here. You know, have you done a proper transfer pricing to ascertain the profit level of the PE, depending on what sort of activities that has been carried out in the PE in Singapore? Now, if you have already an existing set of transfer pricing documentation, and that's before this individual employee is stuck in another country or is seconded, then you may have to update your TP documentation to make sure that they're up to date. And also, if you have suffered any withholding tax on any of these arrangements, then you have to check whether that withholding tax would be a creditable withholding tax when you file your PE return in the various countries, right? And I have got a couple of non-tax consideration here. I think the first point that I think you need to check is whether there's a legal requirement to set up an entity in the host country. Like in Singapore, you must have some form of an entities to carry out some operations here. So in whichever countries that you're in, you will have to check, you know, whether there is a requirement to do so. Then of course, there's this immigration requirement. If I speak from the Singapore angle, then really is whether the individual, if it's not a Singapore citizen or PR, whether you have the necessary employment passes to actually work in Singapore. Right, now at this point is a nice segue for me to basically introduce Rui Yuan. He is from our global mobility solution, and he will be leading the discussion in part 2 of this webinar, where we actually looked at the obligations of you as employer and for the employee. Over to you, Rui Yuan.
Thanks, Emin. So maybe we can move to the next slide. So hi, I'm Brian, and I'm a senior tax manager with Grant Thornton Singapore, providing employer solution services. So basically, this covers anything to do with people, and we provide global mobility services, employment taxes, payroll services, etc. Now that you know what is a PE and how PE may be triggered by having remote workers, our next seminar will look into issues from the employer-employee side of the house. So in part 2, Adrian, a tax partner at Grant Thornton Singapore, and I will discuss the common challenges of managing remote workers. We'll go through case studies as well and highlight what are the key considerations when you have remote workers. To be honest, with the current climate, we have seen many clients coming to us asking us for assistance in terms of how to manage the risk of remote workers. So in the webinar itself, we will also provide our take on the future of remote working, basically how this may look like going forward in the new world. So the link to register for part 2 of the webinar, which is taking place on the 17th of August, is in the chat. So feel free to register for the next session or share with your colleagues who may be interested in finding out more on managing remote workers from the employee perspective. So with this, I will hand it back to Emin and Kat to continue with the Q&A. Over to you, Emin.
Hello again, everyone, and thank you so much, Rayan, for that. So we have moved on to our Q&A session now. So we have about 10 minutes to go through some of our Q&A questions. So as I mentioned at the beginning, please feel free to drop in your questions in the Q&A function, and we'll try and get through as many of them as we can. So I think we'll go through the first question that we have here, and maybe I'll ask that for you, Engmin, is do we need to actually apply for the COVID-19 administrative concession for permanent establishment in Singapore?
Right. Okay. There is no need for you to make an application for the administrative concession to apply on you. But what you need to do as a foreign company is to make sure that you have adequate documentation to support your position, that you actually meet all those conditions that I've mentioned earlier on, like not having a PE in Singapore previously, making sure that, you know, you're able to evidence that there hasn't been any change, you know, in your business model. This individual, whether residing in Singapore or sitting in Singapore or outside Singapore, he's doing the same thing. He's still continue to do the same kind of work. And really it's because of the travel restrictions imposed by COVID. Due to the travel restrictions that this guy can't travel. You know, some countries' borders are really closed and you really cannot go back, you know, unless you meet certain conditions or whatever. So if you can meet all these conditions, then you just assemble them, put it aside. If IRAS call for it, you can just show.
Okay. Great. Thank you, Emin. And we have another question around, so if we did have a permanent establishment in Singapore because of an employee's presence in Singapore last year, but they no longer, we no longer have a permanent establishment this year, and maybe in this scenario it could be because the employee is no longer in Singapore. So they may have gone back to their home country. So do we actually need to inform the IRAS this year that the permanent establishment has ceased?
Now, I think to answer this question, I would just like, I would think that we need to basically look at the position last year, 2020. Was there a PE? Is the concession available to this company? Now, if the concession is available, technically, you would have a PE under either a Section 2 or under the double taxation agreement, but basically IRAS is prepared to waive it and say that, okay, because of all these difficult conditions, I will consider that you don't have a PE in Singapore, right? So okay, now assuming you really have a PE in Singapore last year, and then you don't have any more PE this year, then under Singapore Income Tax Act, if you have a PE and then you have income chargeable to tax, you have profits, that's charged on the PE that's chargeable to tax, then you are legally required to notify IRAS that you have this liability to pay tax. And if you don't receive any return from the IRAS, a request for you to file a Form C or whatever. So there will be a notification requirement more for the period when you have an active PE with profits attributable to that PE. So then you have, a need to basically notify. But otherwise, I don't see that, you need to do anything.
Well, I guess the other part of it is that, if you did have one before and maybe you don't no longer need to have that registration, you could consider deregistering.
Yeah, if you have one, then you
establishment.
That's correct. That's correct.
Yeah. So you could, otherwise you might still have this ongoing thing, and there could be your future. If you don't need it, then you may want to consider deregistering it. Okay. We do have a question around, where most of the employees are working away from the office now, which is very, very common nowadays. They can be working from anywhere, including foreign jurisdictions, without a company's knowledge. So in this case, if the company is unaware that the employee is working in the foreign jurisdiction, would this still create a permanent establishment for the company?
I think, Kat, at the start, we asked about policies, whether the company has got policies on how they manage this PE risk. I would say that ignorance is not a bliss. Not knowing doesn't mean that, you don't have a responsibility or you don't have a PE risk. So it's more a question of having to make sure that, you have a policy to somehow find out where your employees are working and whether wherever they are, would they create a PE for you, especially, in this COVID world that people can actually work from anywhere. Working from home doesn't necessarily mean the same home. It could be in any countries that you want to plant yourself in. So I think you would have to have a policy instead of just saying that we don't know whether the employees are actually working overseas or not.
Yeah, I think if you're of course, if you're unaware, then you're unaware of your permanent establishment risk.
Yes.
But that still could create a permanent establishment there, and that the particular jurisdiction that the employee is in, they could find out ways that you might have a permanent establishment through other means. So, yeah, as you said, Ingmin, ignorance is not a bliss, especially when it comes to tax. We have a question around whether or not if you have hired a person through one of those employee agencies or organizations, so like a professional employer organization in another foreign jurisdiction, would that have any permanent establishment implications?
Well, I think that one actually depends on the arrangement with the PEO, the professional employer organization, because a lot of time in this PEO arrangement that I've seen, the foreign employer continue to give instructions to the employee, and the employee is working in whichever country continue to take instruction and do and report back. So in that case, you are not independent from the foreign employer, and the very fact that you may be considered a dependent agent of the foreign company, that may create a PE for the foreign employer in whichever country that you're in. But if you were to sort of like arrange it such that, that organization that's hiring the employee is actually providing services to that foreign company, then and then you're compensated on a cost plus, and it's just similar to the secondment arrangement that we talked about earlier on, that this guy would become like, an employee of the Singapore company, putting on my Singapore hat, and then provide service to the foreign company. So that you basically cut off that link of that guy as an employee as well as a dependent dependent agent of the foreign company, then you will be able to protect the PE risk. So it depends on the arrangement that you have.
And I guess then it might lead to another question. So this question has come up a couple of times, actually. If we actually hire, if the company actually hires an independent contractor instead of an employee, then would a permanent establishment arise in that foreign jurisdiction?
Yeah, I think this is probably similar to what I've just said. You know, as we discussed, you know, whether this contractor, if this contractor has got only one customer, and that one customer is the foreign company, then this contractor is like a dependent agent of the foreign company, and therefore you cannot say that, you know, you're independent and you cannot, you know, that no PE be created. But if this contractor is in the business of providing a certain service, and the foreign company happens to be just one of its customer, and is not wholly dependent on that foreign company for the work that it's going to do, then that will be fine. Yeah.
Yeah, I think obviously when it comes to tax, yes, the substance is it's substance over form, right? So
yes,
even if you say that he's a contractor, you put in the legal documentation. If there's a contractor, if this person, you know, acts on behalf of you, does everything an employee would, then even though you call them a contractor, that can still create permanent establishment. We're probably coming towards the end of our session now, but maybe I'll take a couple.
Just take one more, a few
more.
Well,
one more, which may be more of an intellectual question, and this actually has come through from a couple of people actually around the relevance of permanent establishment. Now, given that, you know, we have BEPS 2.0, all the pillars or everything that's happening with the G7. And obviously, as we're moving towards more staff mobility, people are moving here and there. Do we think, I think in your opinion, Eng-Min, do you think that the relevance of a permanent establishment will be diminished, or do you think this concept of permanent establishment will become redundant in the future?
Well, I think it depends on which country you're actually talking about. And I think the relevance of a PE is still there, because we want to have the first right to tax it. You know, whichever country would want the first right to tax it before they actually impose the Pillar 1. Pillar 1 actually takes away a lot of things. I mean, you basically, in terms of sourcing rules, you don't care really. You just want to make sure that, you know, the tax is at a certain sort of a rate. So Pillar 1 basically changed a lot of concepts, you know, tax concepts. But I think the concepts of PE would still be there, because ultimately, when it comes to the crunch, it is really where is this income, you know, originating from. So if you're a PE in a country and you're actually running a business operations through the PE, I would believe that, you know, that country would have the taxing right over those profits from that particular PE. But that's my personal view.
I mean, it is, tax sort of moves obviously a lot slower than the digital, like what we're seeing in the digital world as well. So yeah, it could change in terms of how countries would decide to tax or how to collect taxes from companies in the future. But I think it'll be a slow change. I mean, we've been talking about BEPS for, oh gosh, how long has it been now? More than a decade now as well, and we're only sort of moving towards Pillar 1 now. So it is unfortunately a slow process as tax tries to keep up with this changing world of digital. For one, digital tax, people obviously having more mobility and things like that. So we'll hopefully see that. I think we'll slowly see a change in that in the future. Well, I think that was our last question. Unfortunately, we have come to the end of our session, and I thank you to everyone who put in your questions, and apologies to those that we were unable to get to. But if you, as as we mentioned, if you want to reach out to us directly if you have any burning questions, please feel free to email myself or Eng Min, or connect with us on LinkedIn as well, and we can try and address some of your comments there. As Ray Yuan mentioned, we'll have another session, which will be part 2 on the 17th of August. So hopefully we'll see a lot of you at our part 2 session. And thank you so much for joining us this morning. And I hope you found this session enlightening. I hope you had maybe gone away with some thinking points after today. So thank you so much again, and hope you have a lovely rest of the day. And thank you so much, Eng Min, for joining.
Thank you, everybody.